Hello everybody. My apologies for interrupting the video a few hours ago. Actually, I started recording this same lecture and then midway through it, the YouTube had some kind of malfunction and I had to stop it. I thought for a moment that there was a problem with my internet connection, but later on I realized that there was a problem actually with the YouTube service, and some of you might have experienced similar problems as well. So then I'm gonna start from scratch, from the very beginning. The second part of this lecture talking about macroeconomics and GDP. So the next thing that we have to think about is when a recession happens, when an economic downturn happens, what are the indicators? What are the indicators that people use in order to diagnose it, in order to forecast it? What are some of the early signs that a recession might be impending? So that's the first problem or topic for today. The second one will be unemployment statistics and how it is created and used. And finally, the inflation, how inflation is measured. So this lecture primarily deals with the macroeconomic measurements, with the indicators of recessions, with the unemployment statistics, and with inflation statistics. So the first leading indicator of a recession that are used to gauge the likelihood of a downturn are weekly claims to unemployment insurance. So by happenstance today we had a major report out that said that in last week between March 14th and March 21st, these unemployment insurance claims increased in the United States by 3.2 million claims. That's an extreme in statistics was introduced. So that's a very bad sign. That's a sign actually that many people are losing jobs and claiming their unemployment insurance. The main reason for that now is obvious. It's this economic quarantine and lockdown that we are condemned to for a while, for a number of weeks probably, because of the coronavirus. And that's the first sign that we are likely to experience a recession in the future. Labor hours, if the labor statistics shows that even people who are employed are working shorter hours, that's also a sign that the volume of economic activity is declining, and consequently employers have less of a need or a lower demand for labor. Another indication is that the new orders for manufacturing goods are going down, or consumer goods. So this is something that is prospective, that reflects the level of confidence that business people have in the future performance of the economy. So if people are expecting recession to happen, they will decrease the manufacturing orders because the sales are expected to fall in the future. So this is also one of the early indications of economic problems down the road, when people decrease their orders for the future. Inventories decline when the demand increases. So that's usually, not always, but usually is a sign of an increased demand and a better economic situation. Increasing inventories mean that demand is going down and there is a surplus of goods on the market. So increased inventories are a signal to producers of goods to reduce production. So that's a sign of recession down the road. The slowdown of economic activity is likely because the demand has decreased, and this decreased demand is shown in higher quantity of inventories that individual firms and business people are keeping. Building permits for new residential real estate, also a prospective criterion, something that deals with the future. So when are people likely to increase the number of buildings, when they expect that they could sell the higher number of apartments in the future. They will engage in a costly investment in future building on future residential real estate units, and they will acquire building permits if they believe that other people will have enough money to buy the apartments. If the number of building permits goes down, that means that the builders are pessimistic about the future purchasing power, the future spending ability of their customers. Again, unfilled orders for durable goods. So when you order something and you don't fill your order, that's also a sign that the level of economic activity is low and is going to slow down. Stock prices, that should be obvious, and I shouldn't spend too much time talking about the significance of stock prices. So stock prices are one of the early indicators of economic problems. So stock prices, what are stock prices? The stock market is a market in which the expectations about future profitability are traded. That's what stockbrokers do, and that's what people who buy and sell stocks trade in. They trade in with the expectations of future profitability. When you decide to buy a specific stock, you're increasing demand for that stock. You're actually voting with your money that you're increasing your bet that this firm is going to perform well, that this firm is going to have a profit in 3 months or 6 months or 1 year. So stock prices are, in a sense, of future prices. They are the prices that the existing business community puts on a future performance of private corporations that are listed on the stock market. So then if stock prices go down sharply, as they are going down, as they have been going down for a while, they recovered a bit in the last few days, but they're still way below the latest peak few weeks or few months ago. If they go down, that means that the predictions or the expectations of the qualified business community about the future performance of the economy are bad. So actually what the stock market slump tells you, it tells you that the people who buy and sell stocks expect the rate of profitability for the economy as a whole to go down in the future. That's one of the reasons why stock prices indexes like Dow Jones or Nasdaq are good advance warnings about the future recessions. Consumer confidence is a statistical measure showing how optimistic consumers are about buying consumer goods. And this is crucially important for a simple reason. I will show you why. Remember this equation for GDP equals consumer spending plus investment spending plus government spending. That consumer spending comprises 60% of total GDP, of the total income. So if consumers do not feel good about spending their money, that is going to affect dramatically the GDP. So if the index of consumer confidence goes down, that's usually a very good harbinger, a very good predictor of a recession happening in a few months' time. So consumers who are pessimistic right now are consumers who are going to buy less tomorrow, and by buying less tomorrow, they're going to lead to less production and less GDP the day after tomorrow, because lower demand, lower purchases will lead to reduction in the level of production in the economy. So consumer confidence index is very important as an early indicator of the possible recession ahead. However, one of the most precise indications, one of the most precise statistical metrics of the economic performance of an economy is unemployment rate. Unemployment rate has one advantage over all of these early indicators, that it is very stable, very reliable statistics. can have a very strong level of confidence in it, and it shows you if an unemployment rate in an economy as a whole goes up, that's a sign that something bad is happening, and when unemployment is going down, that's a good sign that the economy is advancing or recovering. So comprehensiveness and reliability of unemployment statistics is a good thing. However, the disadvantage of the unemployment statistics is that it is a lagging indicator. Lagging indicator means that the unemployment figures will reflect an underlying change in an economy relatively late in the game. So recession will start happening ahead of time. Many bad things will be happening. Already you might have inferred indirectly from higher inventories, from slumping stock prices, from lower level of consumer confidence, from unfilled orders for durable goods. All of these early and indirect and imperfect indications of the level of economic activity, you may guess or you may suspect that a recession is near at hand, but you will not know for certain until the unemployment and GDP figures are shown, and unemployment figures are going to spike last. So now it's pretty much done deal that we're going to have a decline in national output in the second quarter because of this shutdown of the economy that we have in March and probably better part of the April as well. The country will not be opened up for business. So this will lead probably to a recession or a decline in national output in the second quarter, which means April, May, and June. But the unemployment rate will start significantly going up sometimes in May, not much before then. Maybe it will grow a little bit, but the greatest part of the unemployment increase will come later on. So unemployment statistics is a lagging indicator. Once everything else is revealed in an economy, the unemployment rate spikes the latest. Okay, so these are advantages and disadvantages of unemployment statistics. How the unemployment statistics is collected and how it is defined. It is collected by weekly surveys of the representative sample of people in an economy. That's how it is collected. The definition is the unemployment rate is a percentage of labor force that is not working but is actively seeking work. So it's a percentage of labor force. That's an important concept. That is not working currently full-time, but is actively seeking work, which means applying for jobs. It is on the labor market. So you have here to distinguish between labor force and the total adult population. So labor force is not equal to all adult population, people 18 years or 16 years and older. So that's not the same thing. Labor force is total adult population minus people who do not work usually, who are outside of the labor force. Students who study, homemakers who are in the long run, people who do not work in general, retirees who are not legally allowed to work, prisoners who are also legally not allowed to work. And also another group that is legally allowed to work but is outside of the labor market, discouraged workers. Discouraged workers would be people who simply gave up on trying to find a job. So they're 16 years and older, they have a right, they're citizens or permanent residents, they have a right to work, and they try to find a job for a while, and after a while they simply threw the towel in and decided to give up. These are the people who are long-term unemployed. So they're not counted towards the figures of unemployed. So they're not included into the unemployment figures. So now you can see that the picture about the unemployment is a little bit more complicated than you would have expected on the first glance. Unemployment rate is a percentage of labor force, but how large the labor force as a percentage of total population is, that's a difficult question. So theoretically, you can have a very low unemployment rate as defined in the unemployment statistics, but still to be in a pretty bad situation when it comes to how many people, when it comes to the question of how many people are working. For example, if the labor market participation, so what is labor market participation? That's the labor force as a percentage of total population. Labor force, which means people who work or are actively seeking work but cannot find it. Employed plus unemployed, that's labor force. All adult population is labor force, the first two groups, plus students, homemakers, retirees, prisoners, discouraged workers. So if the number of discouraged workers, because students, homemakers, retirees, prisoners, their numbers are pretty much fixed or pretty much determined in advance. They do not fluctuate so widely. But the number of discouraged workers may fluctuate widely depending on how good the economic conditions are. So one example of that would be that if you have a pretty bad economy, you might have 15% unemployment rate at one point. So you can have 85% of labor force working, 15% of them are unemployed. That means that they are seeking job week after week. And the labor market conditions are so bad that many of them cannot find a job. So maybe out of 15% of them, 10% drop out of the market. That means that they stop looking for a job. This would translate into an unemployment statistics that will show your unemployment rate now being 5%. So on paper, that would look great. The unemployment rate went down from 15% to 10%, but this change hasn't happened because the 10% of unemployed were transferred into employed by finding a job. It actually happened by unemployed actually dropping out completely from the labor market and becoming the discouraged workers, workers who are outside of the labor market. And something like that happened in the early 2010, 11 and 12, that the American unemployment rate was declining steadily, while the number of discouraged workers was increasing steadily. At one point, the unemployment rate, I think this is a figure from 2015, was 4.5%. It's a pretty good number, but when you count part-time workers and discouraged workers, it was 14%. So for 14% unemployment if you count the discouraged workers and those who work part-time. So two statistical figures are here important to gauge how healthy the labor market is. The unemployment rate, percentage of people who seek job but cannot find it, the number of people who seek job but cannot find it as a percentage of total labor force. And the second figure is the number of discouraged workers, or what is the same thing, the labor market participation, the relationship between the labor force and total population. So higher the labor market participation, the better, in principle, and lower the unemployment rate, the better. So if you have low unemployment rate and high labor market participation, that's good. But if your labor market participation is down, then that's not as good as before. So in some situations, it could be a similar outcome. If you have low unemployment rate and low labor market participation, that's the situation described here in the third line. You have a low unemployment rate, but you have then high number of discouraged workers, which means the low labor market participation rate. Or if you have a high unemployment rate, but a lower level of discouraged workers. So there is not much of a difference between these two types of situations.
So these are some of the peculiarities of the labor market that you have to worry when you hear the unemployment rate figures. That's not the whole story. That's an important metric, but what is also important is how many people are discouraged to drop out completely from the labor market. The last twist here, and the further and a further complication could be that sometimes the labor market participation may decline as a consequence of improving economic conditions. If, for example, the hourly wages are increasing significantly, then some families may decide that one of the parents may stay home and take care of children, that they don't need to work both. So this, in that particular case, one of the parents would simply drop out of the labor market, but not because he or she cannot find a job and is discouraged, but rather because the economic conditions are so good that actually one parent could work and the other one uh, devote their time and activity to children or to studying, to going to college, or to investing in your future in other ways that require your absence from the labor market. So in good economic conditions, under certain circumstances, the labor market participation can fall because people don't have so much need to work. That's also possible to happen. So the situation is even more complicated than I portrayed before. In general, it's more likely that the declining labor force participation or labor market participation will be a consequence of people being discouraged. That's more likely. But it could happen also that in some situations people may be dropping out temporarily or maybe in the long run from the labor market because they have other things to do in their life that are more important. Now that earning more income for their families is not so important because they already have enough money, they now want to invest in something else, in college, in raising children, and so on. Okay, that's unemployment. Now, classifications of unemployment. What kinds of unemployment exist? So there are three different types of unemployment. Not all unemployments are created equal. So the first, I will start with this middle one, so-called frictional unemployment. So you may think that an ideal condition of any economy is to have zero unemployment rate, and that's not quite correct. That's not correct because you cannot avoid certain minimal level of unemployment even in a perfectly functioning economy. Why is that the case? Simply because the labor market is very dynamic. Better functioning the labor market and more prosperous and dynamic an economy is, more likely it will be that people will be changing jobs very often. So, for example, in American economy, people are quitting jobs and changing jobs way, way more often than in Europe and in some other countries with a less prosperous economy. If that happens on a large scale, so you would have at any one point in time you will have somebody who is technically unemployed because the unemployment statistics here are collected on a weekly basis. Unemployment statistics are collected on a weekly basis. So in every particular week, you will have, because millions of people are changing jobs every time. Millions of new jobs are being created in America every year, and million jobs are shut down every year. So you will have somebody who is technically unemployed at any one given point in time. I give you just one example just to illustrate this. Imagine a software engineer or a computer engineer working for Microsoft and earning like $1 million per year, and then this software engineer decides to quit the job in Microsoft because of a better offer at Google Corporation, and he has to wait 2 weeks. Actually, he was given 2 weeks, 2 week period to uh, to relocate to California from Washington State. So this person technically would have been classified as unemployed for 2 weeks. But do we really think that this person is some kind of downtrodden proletarian who needs our help and our compassion, or somebody who is in great need of financial help? No, actually, this is a person with good prospects in life, but technically the unemployment statistics doesn't distinguish between him and somebody else who is unemployed for 6 weeks or 6 months in a row. So certain level of unemployment, this is called the frictional unemployment. Frictional because there is a friction always in the labor market. These transitions from one job to another are never seamless, are never instantaneous. They always, almost always, require a certain amount of time, and some people will be at any one point in time. And the assessments are approximately that 1%, 1.5% of people will be unemployed at any one point in time. So the optimal, the maximum employment rate in an economy is never 100%. And the optimal, sometimes called natural rate of unemployment, is never 0%. The reason for that, the primary reason for that, is this frictional unemployment, which is a perfectly healthy and normal and expected phenomenon, and unavoidable phenomenon. Okay, so that's frictional unemployment. Every economy has a frictional unemployment. The second, a little bit more serious thing is the so-called structural unemployment. So now we are dealing here with a more long-term phenomenon, and with something that is not just a friction, it's not that people going around from one job to another, technically being caught in the unemployment statistical average as unemployed. Here is a situation where there is some deeper underlying reason why some people cannot find a job for a longer period of time. So what are these deeper structural reasons for that? There could be two kinds of structural reasons. Number one, it could be technological change. So simply that very fast and radical technological change can make certain kinds of jobs obsolete in a relatively short period of time. Some firms could offer a new product, a new type of a commodity or a consumer good that can make the production activities in other firms that are producing a competing good completely obsolete. And then the labor force, people who are working in these displaced enterprises, may lose their jobs if they're, especially if their training and their knowledge and qualifications were highly specific. Then they will have a harder time of relocating and retraining and re-educating themselves in order to make them employable in some other kinds of industries. So and then you can have a longer term unemployment, which results from technological change that makes certain kinds of jobs obsolete on the market. The second and even more important source of structural unemployment are government regulations, such as minimum wage, such as union protection, such as high payroll taxes, and so on. How does minimum wage affect the long-term structural unemployment? Simply by pricing out of the labor market young and inexperienced and low qualified unqualified workers, because minimum wages increase the prices of the labor of the low wage work, and makes the substitution of low wage work by other things like a higher wage workers and technology more appealing to the businessmen, to the employers. So that's something that you'll probably remember us discussing a while ago, a few weeks ago, that the business proposal, if the minimum wage in a minimum wage on the market is $10, and you can complete as an employer, as a capitalist, as a businessman, the same job by replacing a minimum wage worker with a machine that will cost you $12. You're not going to do that because you're not suicidal. You prefer paying $10 to a living person to perform a job that a machine would cost you $12 for performing. However, if the government steps in and says you cannot pay anyone less than $15 per hour, then what previously used to be an failing business proposition now becomes a very good idea. Now it makes sense for you to replace a worker whom you will have to pay $15 with a machine that costs you only $12. And that's one of the reasons for skyrocketing unemployment rates among the relatively less educated teenagers. That's because they're the primary target of the minimum wage regulations that paradoxically have to help them. They hurt them disproportionately. So you have a structural unemployment, which is not just a frictional form of unemployment. It is a long-term unemployment created by minimum wage regulations that make them structurally less employable than other people. Then union protection. That's also one very important contributing factor to the structural unemployment. The best example of that is Europe. Europe has a much stronger private sector union protections than the United States, and that's why their long-term unemployment, overall unemployment rates are much higher than in the United States. Before this recession had began, in America, the unemployment rate was about 3.2%. In Europe, it's almost never lower than 8 or 7%. And the primary reason for that is a union protection, which means that the union negotiations with employers and the laws giving unions too much power reduce the ability of employers to fire people whom they don't need or who do not perform well. So now if you have a great difficulty firing somebody, that's also a barrier to employing people. If you know that you have that it will cost you too much money and legal bills and time to fire a worker whom you do not need, you're going to think twice before employing that person. So that's the union protection that seemingly paradoxically protects the workers, hurts them in another sense by making employers' decision to hire them less likely. So always you have to bear in mind that high barriers to firing people are barriers to hiring them, and that's why the United States creates so many millions of private sector jobs every year, unlike Europe, in spite of the fact, or exactly due to the fact, that it doesn't have a high private sector union protection. It's easy to fire somebody, and if it's easy to fire people, it's easy to find a job. Finally, cyclical unemployment, that's the kind of unemployment that we are facing now. That's an unemployment that results from a recession, from a general widespread decline in the level of economic activity that happens from time to time, every 5 to 10 to 11 years, depending on the circumstances. Now the last recession was in 2008, 2009. Now this spring, we are very likely to enter into another recession that is probably going to be short. It's going to be much shorter, according to all predictions that we have, much shorter than the previous one, but much more severe, in a sense, much deeper. So the decline in national income in the second quarter of this year will be very steep. 10-15% of GDP will be lost. But then in the third and fourth quarter, we are expected to recover rather quickly and to make up for all of these losses. That's not what happened in the previous recession, 2008, 2009. It lasted for almost 2 years, actually. So the rate of decline over time was lower, but it lasted for much longer. So it's difficult to tell what is best, what is worst. If I were to choose, I would have always chosen the shorter but sharp recession rather than protracted, long and milder recession. So whatever recession, whatever the magnitude and the scope of the recession is, the cyclical unemployment will always result. The unemployment rate will always spike during a recession. So now the question is what to do about it, and that's a difficult and complicated question that depends on your underlying answer to the question what to do about the business cycle or a recession. Could recessions be stopped or moderated in some way by the governments or not? So depending how you answer that question, you are gonna then answer the question what to do about the cyclical unemployment, which is one of the main manifestations and consequences of recessions. Okay, so that's unemployment. Inflation. And that would be the last thing for today. We will conclude the discussion of the introductory discussion of macroeconomics with inflation. So inflation is usually defined in two ways. Traditional definition was that an increase in money supply means recession. Whenever the quantity of money in an economy increases, that's inflation. The second definition that is nowadays much more accepted is that inflation represents an increase in general price level. So I won't go into great detail about the differences between these two. I will tell you just one thing, that the price level, obviously, it makes sense just logically when you think about it. If imagine that the quantity of goods and services doesn't change in an economy from month to month, and you increase the money supply, the quantity of dollar bills that we have by 20%, you would have expected the price level, the price of every one individual item that people buy to increase approximately by 20%. Some of them a little bit more, some of them a little bit less, but on average all prices will increase by 20%. However, if this increase in money supply is coupled with a simultaneous increase in the quantity of goods and services, then theoretically and conceivably you can have a situation in which you increase on the one hand the money supply, but then the productivity of your economy increases even more. Let's say that your money supply increases 20% over a period of 1 year, whereas productivity of the economy increases 30%. So that means that the quantity of goods and services that are produced and traded increased even more. So that would lead to a situation in which, irrespective of an increase in money supply, the price level has gone down because the real productivity of the economy has increased even more. So that's you have to be mindful of that difference. An increase in money supply does not always lead to an increase in general price level. Often it does, because typically the increases in money supply in modern times, at least, are higher than the rate of productivity growth. But it has not always been the case like that. I always like to invoke the 19th century America, in which you had an increase in money supply. Gold was money at that time, and it has been growing by 2 or 3% per year forever, essentially. But in the same time, you had a very rapid rate of economic industrialization and technological change, and economy was growing. The real productivity was increasing way faster than that. So then the price level in America in the late 19th century was declining, in spite of the fact of money supply increasing. So it's theoretically conceivable, it's practically possible that an increase in money supply will lead to a decrease in general price level. But in modern times, in the 20th century, that has not been the case. So that's the reason why nowadays we usually define inflation as an increase in general price level. So what is the general price level? That's some kind of measurement, some kind of statistical index that measures the average of all prices. So that's a measuring device. It's called Consumer Price Index, or CPI abbreviated. So CPI, or Consumer Price Index, measures the prices, how the prices of basic life necessities, basic consumer items that people use in their everyday consumption, what we usually call the cost of living. So you heard probably about that. The CPI, Consumer Price Index, measures the cost of living, which means the prices of basic stuff that we always buy, that an average American family buys every week and every month. How is this Consumer Price Index constructed? How it measures general price level? So then inflation Consumer Price Index is a certain number, And depending on how this number changes from month to month or from year to year, you talk then about inflation or deflation. If consumer price index increases, then you have a positive inflation. If it decreases, you talk about deflation, lower general price level. So now there's a two-step move here, or two-step process through which the consumer price index is created. The first step is to construct something called a representative basket of goods. So what is a representative basket of goods? That's just like a basket that you use to buy stuff in a supermarket. That's a basket in which you put all the basic life necessities that an average family is buying uh, over time. And you put it in the quantities that an average family is buying. That's like 2 carts of eggs, 1 cart of milk, 7 loaves of bread, 3 alcoholic drinks, 7 pieces of clothing, such and such quantity of gasoline or diesel, such and such quantity of money spent on medical care, on education, and so on. In other words, the basic necessities. So you construct an average representative basket of goods that involves the basic necessities that every family is spending, and you calculate approximately on a representative sample. You're not interviewing every single family, but you approximately calculate what is the average quantity of every one of these units: food, drink, clothing, energy, transportation, medical care, that an average family is buying. Okay, so that's the first step, representative basket of goods. And now what you want to follow over time is actually how the prices, how the costs of this representative basket change over time. So all of these items have their prices at any one point in time. So what the consumer price index is the price of the representative basket of goods, price in dollar terms. So how is this price in dollar terms, this price of representative basket of goods in dollar terms calculated? It's very simple. So you start from the reference point, from 1 year or 1 month from which you want to calculate the consumer price index, to calculate the price level. And you say, okay, such and such quantity of food, drink, clothing, energy, transportation, etc., are included in the basket. And then you make the calculation. Let's say the examples are kind of stupid, simple-minded examples that I invented here just to illustrate for you the process of calculating it. 2 loaves of bread. Let's say that an average family is buying 2 loaves of bread per week, times $2, $2 a piece, $2 per loaf of bread, plus 4 pounds of meat. Let's say that that's an average expected consumption of meat per week, times average price $3, plus 4 pieces of clothing times $2.5 and so on. And then you calculate all of that, you get a certain dollar amount. And this dollar amount that sums up all the entire expenditure that an average family has for a representative basket is the value of the representative basket. And it's in dollar terms, let's say, wherever the number is. And now you set the second important step here is once you calculate the dollar value of the representative basket of goods, you set that dollar value in the reference period, in the first period from which you start measuring and comparing price levels over time. You set it at 100. So CPI for that month is 100. So that's the consumer price index for the first month. So wherever, if let's say that we want to measure what happens with the general price level between year 2019, January 2019 and January 2020. And let's say that in January 2019, we calculated by this method that I just described, that an average basket of representative goods costs $1,590. So that's the calculation of the costs of living of the representative basket in January 2019. Then you automatically set this as 100. And now then you calculate the value of the same representative basket in January 2020. You perform the same calculation, 2 loaves of bread times whatever the price per loaf is in January 2020. 4 pounds of meat times whatever the price of meat in January 2020 is, plus 6 gallon of gasoline times the price per gallon that is relevant in January 2020 as opposed to 2019. And then you get a calculation, you get the sum total of these costs for January 2020. This is, let's say, 1650. So that's the value of representative basket. Now you want to calculate the inflation rate between January 2019 and 2020. The simple formula for that is this formula in the second row here. The cost of the period 2, in our case that would have been January 2020, over the cost over the reference period or period 1, cost in dollar terms, times 100. So now what you do, you then divide cost in the period 2 is $1,650 divided by $1,590 in period 1 times 100. You're gonna get then some number that is 1 point something times 100. So then you get the CPI for the period 2. This is important to bear in mind. When you do this calculation, you don't get the inflation rate directly. You get the CPI2, CPI for the period 2. You see, CPI for the reference period is conventionally set at 100. However, for the period 2, you have to calculate the CPI. So CPI for period 2 here would be, let's say, 1.1. When you divide 1650 over 590, you will get maybe 1.1 or 1.2. It doesn't matter. Let me calculate for you for a moment. So let's say 1650 over 1590 equals 1.03. So that's 1.03. Denominator and numerators are both in dollars. When you divide them up, they cancel each other out. So you get just a raw number, 1.03 times 100 is 103. So your calculation shows then the CPI2, CPI for the subsequent period, January 2020, is 103. Since the CPI for the reference period, for the first point in time, January 2019, is 100 by definition, then your inflation rate between the two Januaries, 2019 and 2020, is 103 minus 100, or 3%, 3 point something percent. Okay, so the inflation rate is a difference between consumer price index calculated for the later period of time by using this formula over here, cost of period number 2 in dollar terms over cost of period 1 in dollar terms times 100. That's the key formula. And once you calculate the CPI for the second period, you just subtract from it 100. So you can imagine now, we can play around a little bit. Imagine that the boot was on the other foot, so to speak, that we start from 1650 in January 2019, and then the representative basket costs you 1590 in January 2020. So then what would have happened here? You would have then to divide 1590 as a value of consumer basket in the period 2 with 1650, which is the value of the representative basket in the period 1 from which you started. So the CPI declined, obviously. So that would have been 0.96. So 0.96 times 100, that would have been 96.3. So you would have then the rate of deflation of some 4%, 3.7% negative inflation. So that's the way how you calculate inflation versus deflation. So remember always the reference period, which is the period from which you start measuring or comparison over time, is always set at 100. So if the value of consumer basket increases over time, then the CPI for the subsequent period will be greater than 100 and inflation rate consequently higher than 0%. And if the value of consumer basket declines in the meantime, then you will have a CPI2 which is lower than 100% and inflation rate then which is lower than zero, smaller than zero. Okay, just a few more things about inflation. The easiest way to think of inflation is that it represents a tax on saving and investment. So why is inflation a tax? Inflation is tax because if your income doesn't change, it reduces the purchasing power of your income over time. So imagine that your salary remained the same, but the representative basket of goods was 1,590, and then after a year it increased to 1,650. So that would mean that for the same nominal salary that you had, you will have the ability to buy less goods and services than before. So you will have to sacrifice some of the items that you could have bought before, you will have now to sacrifice them. So by decreasing the purchasing power of money, inflation does the same thing as if somebody taxed your income, for example, directly. From your individual consumer's point of view, it doesn't matter one bit whether you are robbed by somebody taking 3% of your income at gunpoint, or through taxation, or you lost it, or that government increased prices 3% while your income remained the same. So you can buy for the same nominal money, for the same nominal income, you can buy 3% less goods and services. So that's the reason why inflation is a tax. And it is a tax on saving and investment. This is very important. Tax is bad for saving and investment because what you do when you save and invest money, you're actually postponing your consumption. So you're exchanging present money for future money. When I lend you $100 in exchange for a promise to pay me back $105 with interest, or even without interest, let's simplify. Let's say just to return me $100 in 6 months. And if we expect that inflation is gonna happen in the meantime, so that means that I'm gonna receive $100 in 6 months that will have lower purchasing power than the $100 that I'm giving you now. So that I will think twice before I decide to save money and lend it to you or to invest into something. When you invest, you're buying goods and services right now. You are paying wages, you're buying raw materials, you're investing in real estate, you're paying the factors of production now at lower. You're paying factors of production with the money which has a higher purchasing power. And now you will be selling, once you produce something and sell it on the market, inflation will make your prices of your goods and services maybe nominally higher, but in real terms lower. Then the purchasing power of every dollar that you receive will be lower than before. So that's why saving and investment are discouraged by inflation. On the other hand, borrowing and spending are encouraged by inflation. So if you have $100 now and you think that inflation is gonna be high tomorrow, so then it's better for you to spend your money right now on consumer goods rather than to wait tomorrow and then buy less consumer goods for the same amount of money. So spend as much as you can right now. That's what inflation says to you. Also, it's good to borrow money. If you can find the poor sucker who is going to lend you the money right now, it's a very good deal because you're going to be paying back that in the money of lower purchasing power. So actually, the inflation rips off creditors for the benefit of debtors. So if you don't believe me, you have just to look at what happens in a country that has a very high rate of inflation, the so-called hyperinflation, astronomical rates of price level growth, that people are always trying to spend as quickly as possible, as much money as they have, because they know that tomorrow or sometimes after a few hours, money might lose a great part of of its purchasing power. Remember, my mom was employed in early 1990s with a high rate of inflation, with an astronomical inflation rate in former Yugoslavia. And she remembers time when she would just receive her salary in dinars in the worthless currency that was inflating like crazy every day. And she would have to run downtown to exchange this worthless paper for a hard currency for German marks, or to find and buy anything she could find. Whether she needed it at that particular moment or not, but she knew that by tomorrow the money would be worth maybe 10 or 20% of what is it worth, what it was worth at that particular point. So that's just one extreme example of how inflation impoverishes people by forcing them to spend very quickly and by reducing the amount of goods that they can spend. But the same is true for every level of inflation. It might not be so obvious when you have a 5% inflation, but it's essentially the same phenomenon. Okay, so that's all I've got for today. I will post this YouTube video in a short while. In the meantime, feel free to send comments and questions that you might have about this chapter and about the lecture, and I will post in due course my answers to them. So please don't hesitate if you have any questions whatsoever about any of this, because it's difficult for me to gauge the level of your understanding of this, because I don't have any feedback. So help me do it by simply sending me your questions. I will open actually a discussion on Canvas where you can post your questions and comments, so then I can address them afterwards in a shorter, smaller subsequent video. Okay, stay healthy, don't panic, and patiently wait for the lifting of this quarantine. I think that it may take a while, but eventually by late April we will probably be out of the woods. So good evening to everybody, and I'll see you again soon in virtual space. Bye bye.